A Random Walk Down Wall Street number 2. Popular Frenzy High, lovely readers. I'm Miss CSPX, and welcome back to our AI Finance 101 reading series. Last time, we dove into the heart of a random walk down Wall Street, exploring the random walk theory, how short-term stock prices are so unpredictable, and the difference between investing and speculating. We also learned about the firm foundation theory, the castle in the air theory, and took a trip back to the Dutch tulip mania of the 17th century. Today, we're continuing our adventure through a random walk down Wall Street, focusing on historical speculative bubbles and the wild, irrational side of markets. Here's what we'll cover. 1. The South Sea bubble of the 18th century. 2. The crash of 1929-3. The tech frenzy of the 1960s. 4. The M&A and growth stock craze ready to jump in? Let's get started. First section, the South Sea bubble of the 18th century. While the Dutch tulip mania left people in awe, the South Sea bubble in 18th century England was an even bigger frenzy. In 1711, the South Sea Company was founded, granted a monopoly by the British government to trade in the South Sea region and sell government bonds. Despite tiny profits from the South American trade, their lavish offices and executives' glamorous lifestyles convinced everyone the company was a gold mine. Stock prices soared. Across the Channel in France, John Law created the Mississippi Company, pushing paper money over gold and silver with government backing. This sparked a speculative fever, with stock prices rocketing from 100 to 2,000 francs, making the company's value 80 times the entire French economy. In 1720, the South Sea Company proposed raising £31 million to fund government bonds, and the stock price jumped from £130 to £1,000. Even the king bought £100,000 in shares. The market went wild, with nearly 100 similar companies popping up, some claiming to work on highly profitable but mysterious ventures. Investors poured in within hours, but when South Sea executives started selling their shares, the news leaked and the bubble burst. Even Isaac Newton lost a fortune, sighing that he could never predict the madness of crowds. Second section, the crash of 1929. Fast forward to the late 1920s in the United States, where stock market speculation became a national obsession. Legal stock pools and shady market tricks were everywhere. On September 3, 1929, the market hit an all-time high. But just 2 days later, financial advisor Roger Babson warned, "A crash is coming." His words triggered a sharp drop, known as the Babson crash. The decline dragged on until 1932, with many blue-chip stocks losing over 95% of their value. Investors were wiped out, and the Great Depression swept across America. Third section, the tech frenzy of the 1960s. In the 1960s, the U.S. stock market was buzzing again, this time with growth companies like IBM and Texas Instruments boasting price-to-earnings ratios over 80. Speculators believed any stock could double overnight. Between 1959 and 1962, new stock offerings hit record highs, especially for anything labeled tech. Some companies even rebranded to include technology in their names, boosting their PE ratios from 6 to 42. Shell companies with no real business raised millions, despite warnings in their prospectuses about no assets, no earnings, high risks. When the bubble popped, most of these stocks became worthless, and regulators could only watch the chaos unfold. Fourth section, M&A and the growth stock. Craze after the 1960s, the U.S. saw a wave of mergers and acquisitions, M&A. Investors played a tricky game, buying low PE companies with high PE ones, merging their assets to inflate the overall value. For example, if a tech darling like Apple acquired a stable company like General Electric, GE's assets would suddenly be valued at Apple's sky-high multiples. It was like a Ponzi scheme, collapsing when earnings dropped. Then came the growth stock craze, where fund managers chased future potential and shiny stories. One company, originally selling farm equipment, rebranded as a performance systems innovator, and its valuation soared. But by 1970, the bubble burst, and its stock plummeted 99%. These stories show how markets can get carried away by hype, not real value. Summary today, we explored a random walk down Wall Street's second chapter, all about speculative bubbles fueled by crowd frenzy. We revisited the South Sea bubble, where lavish appearances drove stocks to dizzying heights before crashing. We saw how the crash of 1929 sparked the Great Depression through unchecked speculation. The tech frenzy of the 1960s showed how a simple name change could inflate valuations, and the M&A and growth stock craze revealed the dangers of chasing hype over substance. These moments remind us that market euphoria can lead to heartbreak. So, what about the nifty 50 stocks of the 1970s? Did they make investors rich? Let's find out next time. Next episode. Preview, that's all for today, friends. In our next session, we'll keep exploring a random walk down Wall Street, diving into the rise and fall of the nifty 50 stocks and uncovering more market secrets. If you're loving our AI Finance 101 series, please share it with your friends and invite them to join our learning journey. I'm Miss CSPX, and I can't wait to see you next time.